Welcome back to Everyman Prepping. I have some breaking news. I just put a community post about it, but the Silicon Valley Bank has been taken over by the FDIC. It has collapsed. There's no deposits right now. You can't get access to your money. So let's go over this. What happened to this bank and why? And is there going to be a contagion effect leading to other banks, which it might. But this is what I always talk about. A bank run started happening. They didn't have the assets to cover it, and the bank has failed. And this was a big bank, venture capital bank in Silicon Valley. It funded a lot of startups, venture capital, a lot of money just went out the door. So let's look at this really quick here. So I'm going to kind of go backwards in time with this report. This is yesterday. The SVB, which is the parent of Silicon Valley Bank, they lost 62% of their value in their stock yesterday. People started taking money out. And it says here that David Faber reports that SVB, Silicon Valley Bank, sought an advisor to find a buyer after attempts to raise capital have failed. So they tried to get loans. What they did is they sold off a bunch of bonds. They had to sell bonds in order to pay depositors that were taking the money out because they don't have. It's fractional banking. They don't have your cash in the bank. Your money's not there. If a lot of people go to draw out millions and millions, they don't have it. They have to sell their bonds for cash in order to get the cash to give their people their money back. Well, the bonds they're selling are at a huge loss because they bought them when interest rates were near zero, and now they're near 5%, so they're taking huge losses. They tried to raise money, they couldn't do it. Going on, it says, Faber added that deposit outflows were outpacing any efforts to find a buyer, so they couldn't find a buyer yesterday. Then we have an update here, 10:30 Eastern time last night. Treasury Secretary Janet Yellen said the department is monitoring a few banks amid this issue. So will this be, like I said, a contagion event? Will other banks go down? It could be. It says there are recent developments that concern a few banks that I'm monitoring very carefully, and when banks experience financial losses, it is and should be a matter of concern. SVP's told its employees in a memo on Friday that they should work from home until further notice. So that's not good news. You know what that means? Massive layoffs coming. And then going up here to the beginning, we have the FDIC shutters Silicon Valley Bank, appoints a receiver for it, so it's taken over it. California regulators have taken possession of it. They're going to try to give money back to people that are insured. Insured is up to $250,000 per account. Sometimes if there's two people on account, it could be up to $500,000, but that's a bunch of legalese that someone needs to figure out. But let's just say it's $250,000 per account that's insured. It says the FDIC noted that the Silicon Valley Investment Bank had $175 billion in deposits as of December 31st of last year, and that there's $151 billion of those are uninsured. So most of that is uninsured. That's a lot of money to lose. That's a lot of people going to lose a lot of money. It says here, and just like that, SVB is no more, a historic collapse, which in many ways was faster than Lehman. And basically, its stock plunged from $736 to zero in 16 months. This is the second biggest bank failure compared to Washington Mutual, which failed in 2008, which we know what happened in 2008. So second biggest bank failure out there. The FDIC put a statement out. It's here, but I'm going to go to the actual statement here. Let me blow this up so you guys can read it a little easier. Let's see if we can get this in here so you can read it. So this says here the Silicon Valley Bank of Santa Clara, California was closed today by the California Department of Financial Protection and Innovation. The FDIC has taken it over, and it's in receivership of it. This says all insured depositors, insured, that means up to $250,000, not the uninsured people, the insured ones, will have access to their insured deposits no later than Monday morning, March 13th. I wouldn't hold my breath on that, but supposedly by Monday, you can at least pull $250,000 out if you had it or if you had less than that. The FDIC will pay uninsured depositor an advance dividend within the next week. That means nothing. They're going to give you a piece of paper. It says that those uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. So it's like an IOU. And what this is the FDIC, like it says here, they're going to try to sell the assets off it, and they'll try to pay back those uninsured people. I don't know who gets in line first, but if you are uninsured over that amount, you better start calling the bank and figuring out how you get in line for that. let's see, they had 17 branches in California and Massachusetts, but they had a lot of money. Like I said, second biggest bank in terms of funds, in terms of money. What else do we have here? It says, customers with accounts in excess of $250,000 should contact the FDIC at this number to probably be told that you are going to get a piece of paper, an IOU, and you might see your money or you might never see it. So that is a huge happening right now. Those other banks are talking about. Let's look at this here. I went to this really quick, so I don't have a lot of this blown up for you guys. Here you go. So top decliners. What else do we have? Signature Bank, First Republic Bank, Charles Schwab in here. So maybe I can shrink that down so you can see it better. Charles Schwab Corp. So those are huge. Look at 22.4% down on Signature, 17% on First Republic, 8% on this real estate group, Charles Schwab at 8%. So if you have money in these areas as well, you might want to think about moving your money. I'm not telling you to move your money. I'm not telling you to go to your current bank and do that, but we all need to watch this because it could be a contagion event. It could be, something where another bank fails. Maybe First Republic goes because they have too many bonds as well and not enough, assets on hand. Remember, all these banks are fractional reserve banking. The money you put in there is just digits in a computer. It's not cash sitting in there. They take your money and then they loan it out 10, 15 times that amount of what they have on hand. And then when everybody comes and get it, like happened to Silicon Valley Bank, they don't have it. They sell their bonds. They take huge losses. And then like this one, it failed. So this could be the event of a bigger thing. I don't know if it's something to watch. I just want to get it out there that first of all, if you know anybody that had money in that bank, they need to figure out what they're going to do immediately. Also, keep an eye on your bank stock, whatever it is. Look up news on them, see if there's any problem with them, and, make a personal decision. Do you want to move your money out of there? Do you want to move it somewhere else? Do you want to go to a credit union? Now, credit unions are insured separately. They're not even insured by the FDIC. They have their own thing, so you need to investigate that. But I want to get this word out as fast as possible. When I find out more information, I'll let you know. But until then, keep your ear to the ground and head on a swivel.